How to get out of debt. Debt can be a heavy burden to carry. Whether it's student loans, credit cards, or a mortgage, the weight of owing money can cause stress, anxiety, and sleepless nights. The good news is that you don't have to carry this burden forever. With the right strategies and mindset, it's possible to get out of debt and achieve financial freedom. This book, How to Get Out of Debt, is a comprehensive guide to help you do just that. It's a practical and actionable resource that will provide you with the tools and knowledge you need to take control of your finances and work towards a debt-free life. Throughout this book, you'll find step-by-step instructions on how to create a budget, negotiate with creditors, and manage your spending. You'll also learn about different types of debt, how they work, and the most effective ways to pay them off. From building an emergency fund to avoiding common debt traps, this book will provide you with a wealth of information and tips to help you stay on track and achieve your financial goals. But this book is not just about practical advice. It's also about the emotional and psychological factors that can hold us back from becoming debt-free. The authors understand that getting out of debt is not just a financial decision, but also a personal one. They provide insight into the mindset shifts that are needed to overcome the barriers to financial freedom, and to maintain the motivation and discipline required to stay debt-free. In short, How to Get Out of Debt is a must-read for anyone who wants to improve their financial well-being. Whether you're just starting to get a handle on your finances or you're looking for advanced strategies to tackle your debt, this book has something for you. I highly recommend it as a valuable resource and guide on the path to financial freedom. Chapter 1: The History of Debt and the Rise of Consumerism. Debt has been a part of human society for thousands of years. In ancient times, people borrowed from each other for various reasons, such as financing businesses or purchasing goods. However, it was not until the Industrial Revolution in the 18th and 19th centuries that debt became a widespread and integral part of modern society. Advances in technology and the rise of capitalism led to the growth of lending institutions and the emergence of consumer credit. In the United States, the use of credit started to become more widespread in the early 20th century. At first, it was primarily used for big purchases such as homes or cars. However, with the post-World War II economic boom, consumerism became an increasingly significant part of American life. The advent of television and advertising led to a cultural shift that emphasized the importance of owning material possessions, and credit became an essential tool for making that possible. In the 1960s and 1970s, credit card companies began to offer easy credit to the average consumer, and soon it became common for people to use credit cards to buy not just big-ticket items, but also everyday purchases such as groceries and clothing. With the availability of credit, people could have the lifestyle they desired without having to wait until they had saved enough money to pay for it. This shift in consumer behavior had a profound impact on the American economy. As people spent more and more, businesses began to rely on consumer credit to drive growth. Credit card debt, in particular, grew at an alarming rate, and by the early 2000s, many Americans found themselves struggling with overwhelming debt. Today, debt has become a normal part of life for many Americans. According to the Federal Reserve, the total household debt in the United States was over $14 trillion in 2020, with the majority of that debt in the form of mortgages and student loans. Despite the potential pitfalls of over-reliance on credit, it's clear that debt is here to stay. But that doesn't mean we should accept debt as an unavoidable part of our financial lives. By understanding the history of debt and the cultural and economic factors that led to its rise, we can begin to take control of our finances and make informed decisions about how we use credit. In the following chapters, we'll explore the strategies and tools you can use to get out of debt and achieve financial freedom. Chapter 2: Understanding the different types of debt. Not all debt is created equal. There are different types of debt, each with its own characteristics and considerations. Understanding the different types of debt is essential for developing an effective strategy for managing and paying off your debt. 1. Secured debt is debt that is secured by collateral, such as a home or car. If you fail to make payments on a secured loan, the lender can seize the collateral to recover the outstanding balance. Mortgages and car loans are common examples of secured debt. Secured debt tends to have lower interest rates than unsecured debt, as the collateral provides security for the lender. 2. Unsecured debt is not backed by collateral and is based solely on your creditworthiness. Credit card debt, personal loans, and medical bills are examples of unsecured debt. Unsecured debt tends to have higher interest rates than secured debt, as there is no collateral to secure the loan. 3. Revolving debt is debt that you can borrow, pay off, and borrow again, without having to reapply for a loan. Credit cards are the most common form of revolving debt. With revolving debt, you only pay interest on the amount you borrow, not on the total credit limit. It's important to pay off your revolving debt as soon as possible to avoid accumulating high-interest charges. 4. Installment debt is debt that you repay in fixed amounts over a set period, such as a car loan or a student loan. With installment debt, you pay the same amount each month, including interest and principal. The interest rate for installment debt is typically fixed, meaning it won't change over the life of the loan. 5. Payday loans are short-term loans that are typically due on your next payday. They often have high interest rates and fees, making them a very expensive form of borrowing. Avoid taking out payday loans if possible, as they can quickly lead to a cycle of debt. 6. Student loans are loans specifically for education-related expenses, such as tuition, textbooks, and living expenses. They often have lower interest rates than other types of unsecured debt, and the interest may be tax-deductible. However, student loan debt can be substantial, and it's important to have a plan for repaying it after graduation. Understanding the different types of debt is the first step in developing a strategy to manage and pay off your debt. In the following chapters, we'll explore the various methods and tools you can use to tackle each type of debt and achieve financial freedom. Chapter 3: Creating a budget to manage your debt. One of the most important steps in managing your debt is creating a budget. A budget is a plan that outlines your income and expenses and helps you understand where your money is going. By creating a budget, you can identify areas where you can cut back on spending and allocate more money towards paying off your debt. Here are the steps to create a budget. 1. Determine your income. 2. The first step is to determine your total income. This includes your salary or wages, any rental income, and any other sources of income. Be sure to include all sources of income to get an accurate picture of your financial situation. 3. List your expenses. 4. Next, list all of your monthly expenses. This includes rent or mortgage payments, utilities, car payments, groceries, entertainment, and any other expenses you have. Be sure to include all of your expenses to get an accurate picture of your monthly spending. 5. Categorize your expenses. 6. Once you have listed your expenses, categorize them into fixed and variable expenses. Fixed expenses are expenses that do not change from month to month, such as rent or car payments. Variable expenses are expenses that can vary from month to month, such as groceries and entertainment. 7. Analyze your expenses. 8. Take a close look at your expenses and determine if there are any areas where you can cut back. For example, you might be able to reduce your entertainment expenses or cut back on dining out. Look for ways to save money without sacrificing your quality of life. 9. Determine your debt payments. 10. Finally, determine how much money you can allocate towards paying off your debt each month. Ideally, you should aim to pay more than the minimum monthly payment to reduce the overall interest you'll pay over time. Once you have created your budget, you can use it to track your spending and make adjustments as needed. It's important to be honest with yourself and stick to your budget to achieve your financial goals. In addition to creating a budget, there are other strategies you can use to manage your debt, such as debt consolidation, negotiating with creditors, and seeking professional help. In the following chapters, we'll explore these strategies and more to help you become debt-free. Chapter 4: Reducing Expenses. When you're trying to pay off debt or save money, reducing expenses can be a powerful tool. By cutting back on unnecessary spending, you can free up more money to put towards your financial goals. Here are some strategies for reducing your expenses. 1. The first step in reducing your expenses is to create a budget. This will help you see exactly where your money is going and identify areas where you can cut back. Be sure to include all of your income and expenses, both fixed and variable. 2. In addition to creating a budget, it's important to track your spending on an ongoing basis. This will help you stay accountable and make adjustments as needed. You can use an app, spreadsheet, or good old-fashioned pen and paper to keep track of your expenses. 3. Discretionary expenses are non-essential items or services that you can do without. This might include things like dining out, buying clothes or electronics, or going to the movies. Look for ways to cut back on these expenses, like bringing your lunch to work instead of eating out, shopping for clothes at thrift stores, or using streaming services instead of going to the movies. 4. Many bills are negotiable, including things like cable, internet, and phone service. Call your providers and ask if there are any discounts or promotions available. You might be surprised at how much you can save just by asking. 5. While fixed expenses like rent or car payments may not be negotiable, there are still ways to reduce them. For example, you might be able to refinance your mortgage or car loan to get a lower interest rate. You could also consider downsizing to a smaller living space or a more fuel-efficient car. 6. Before making a purchase, check for coupons or discounts that might be available. This could include online promo codes, in-store coupons, or cashback apps. Just be sure to only use coupons for things you actually need or were planning to buy anyway. 7. Instead of paying for services or products, consider doing it yourself. This might include things like cooking at home instead of ordering takeout, cutting your own hair, or cleaning your own house. Reducing expenses may take some effort and sacrifice, but it can be a powerful tool for achieving your financial goals. By creating a budget, tracking your spending, cutting back on discretionary expenses, negotiating bills, reducing fixed expenses, using coupons and discounts, and DIYing whenever possible, you can free up more money to put towards your debt or savings. Chapter 5: Increasing Income. When it comes to getting out of debt, cutting expenses is important, but it can only go so far. Increasing your income is another crucial part of the equation. Here are some ways you can increase your income. 1. Work overtime. 2. If your job allows it, working overtime can be a great way to boost your income. Not only will you earn extra money, but you'll also demonstrate your dedication and work ethic to your employer. 3. Find a higher paying job. 4. If you're not earning enough at your current job, consider looking for a higher paying position. Keep an eye out for job openings in your field and make sure your resume and cover letter are up to date. 5. Start a side hustle. 6. Starting a side hustle can be a great way to earn extra income in your spare time. There are many options to choose from, such as freelancing, tutoring, pet sitting, and selling items online. 7. Rent out space. 8. If you have extra space in your home, consider renting it out on a short-term or long-term basis. You could rent out a spare room on Airbnb or rent out a parking spot in a high-demand area. 9. Sell items you don't need. 10. Selling items you no longer need can be a quick way to earn extra cash. Look for items you haven't used in a while, such as clothes, electronics, or furniture, and sell them online or at a garage sale. 11. Participate in online surveys. 12. Many companies are willing to pay you for your opinion through online surveys. While the pay is generally low, it can add up over time if you're consistent. 13. Rent out your car. 14. If you have a car that you don't use all the time, consider renting it out through a peer-to-peer car rental service like Turo. By increasing your income through one or more of these strategies, you can accelerate your debt repayment and achieve financial freedom more quickly. Just make sure that any additional income you earn is put towards paying down debt and building up your savings. Chapter 6. Understanding debt consolidation. If you're struggling with multiple debts, debt consolidation can be an effective strategy to manage your debt. Debt consolidation involves combining multiple debts into a single loan with a lower interest rate and a more manageable payment plan. However, debt consolidation is not a one-size-fits-all solution and comes with its own set of benefits and drawbacks. Benefits of debt consolidation. 1. Simplified payments. By consolidating your debts into a single loan, you'll only have to make one payment each month instead of multiple payments. This can make it easier to keep track of your payments and avoid missed payments or late fees. 2. Lower interest rates. If you have high-interest credit card debt, consolidating your debt into a lower-interest loan can save you money on interest over time. This can help you pay off your debt faster and more cost-effectively. 3. Improve credit score. Consolidating your debt can also help improve your credit score by reducing your overall credit utilization. A lower credit utilization can help boost your credit score and make it easier to obtain credit in the future. Drawbacks of debt consolidation. 1. Not for everyone. Debt consolidation may not be the best option for everyone. If you have a low credit score, you may not be eligible for a low-interest loan. Additionally, if you have a high debt-to-income ratio, you may struggle to qualify for a consolidation loan. 2. Fees and costs. Debt consolidation can come with fees and costs, such as loan origination fees, closing costs, and prepayment penalties. Be sure to compare the costs of consolidation against the potential savings to determine if it's the right option for you. 3. Risk of accumulating more debt. Consolidating your debt can provide temporary relief, but it's important to address the underlying spending habits that led to your debt in the first place. Otherwise, you may find yourself accumulating more debt and struggling to make payments on the consolidation loan. Debt consolidation can be an effective strategy for managing your debt, but it's important to weigh the benefits and drawbacks before making a decision. If you decide that debt consolidation is the right option for you, be sure to compare lenders and carefully review the terms and conditions of the loan before signing on the dotted line. Chapter 7: Negotiating with Creditors. If you're struggling to make payments on your debts, negotiating with your creditors can be a helpful strategy to get back on track. By reaching out to your creditors and explaining your situation, you may be able to negotiate a lower interest rate, a reduced payment plan, or even a debt settlement. Here are the steps to negotiate with your creditors. 1. Gather information. 2. Before reaching out to your creditors, gather all of the information you'll need to negotiate effectively. This includes your account numbers, outstanding balances, and any recent statements or correspondence. You'll also want to review your budget to determine how much you can realistically afford to pay each month. 3. Reach out to your creditors. 4. Next, reach out to your creditors to explain your situation and request a lower interest rate or reduced payment plan. Be honest about your financial situation and explain why you're struggling to make payments. Your creditors may be willing to work with you to find a solution that works for both parties. 5. Be prepared to negotiate. 6. Your creditors may offer you a lower interest rate or reduced payment plan, but it's important to be prepared to negotiate. If the initial offer is not feasible for your budget, ask if they can reduce the interest rate further or extend the repayment period. You can also request a debt settlement if you have a lump sum available to pay off the debt. 7. Get everything in writing. 8. Once you've agreed to a payment plan or debt settlement, be sure to get everything in writing. This includes the terms of the agreement, the payment schedule, and any other important details. Keep a copy of the agreement for your records and be sure to make your payments on time to avoid any additional fees or penalties. Negotiating with your creditors can be a helpful strategy to manage your debt, but it's important to approach the negotiation process with a clear understanding of your financial situation and a realistic budget. Be prepared to negotiate and get everything in writing to protect yourself and ensure that you're able to follow through on your agreement. Chapter 8: Understanding Bankruptcy. If you're facing overwhelming debt that you're unable to manage, bankruptcy may be an option to consider. Bankruptcy is a legal process that provides relief for individuals and businesses with excessive debt. While bankruptcy can help eliminate or restructure your debt, it also has significant consequences that should be carefully considered before filing. Types of bankruptcy. There are 2 types of bankruptcy that individuals can file for. 1. Chapter 7 bankruptcy, also known as a liquidation bankruptcy. Chapter 7 bankruptcy allows you to discharge most of your unsecured debt, such as credit card debt and medical bills. However, you may have to surrender some of your assets, such as a car or a home, to pay off your creditors. Not everyone is eligible for Chapter 7 bankruptcy, as there are income requirements that you must meet. 2. Chapter 13 bankruptcy. Chapter 13 bankruptcy is a reorganization bankruptcy that allows you to create a repayment plan to pay off your debts over a period of 3 to 5 years. You can keep your assets, but you'll need to make regular payments to a trustee who will distribute the funds to your creditors. Pros and cons of bankruptcy. Pros. 1. Discharge of debt. Bankruptcy can provide relief from overwhelming debt by discharging most unsecured debts. 2. Protection from creditors. Once you file for bankruptcy, creditors are prohibited from contacting you or attempting to collect on your debts. 3. Fresh start. Bankruptcy can give you a fresh start and an opportunity to rebuild your credit. Cons. 1. Credit score. Bankruptcy will have a significant negative impact on your credit score, making it difficult to obtain credit in the future. 2. Asset loss. Depending on the type of bankruptcy you file, you may have to surrender some of your assets, such as a car or a home, to pay off your creditors. 3. Stigma. Bankruptcy can carry a stigma that may affect your personal and professional relationships. Bankruptcy is a serious decision that should not be taken lightly. Before filing for bankruptcy, it's important to explore other options, such as debt consolidation or negotiating with your creditors. If you do decide to file for bankruptcy, it's important to consult with an experienced bankruptcy attorney to guide you through the process and help you make informed decisions. Chapter 9. Building an emergency fund. Once you've paid off your debt and taken a major step towards financial freedom, it's time to shift your focus towards building an emergency fund. An emergency fund is a critical component of financial security because it can help prevent you from going back into debt when unexpected expenses arise. What is an emergency fund? An emergency fund is a pool of money set aside specifically for unexpected expenses. This could include a medical emergency, car repairs, or a job loss. The goal of an emergency fund is to have enough cash on hand to cover these expenses without having to rely on credit cards or other forms of debt. How much should you save? The general rule of thumb is to save 3 to 6 months' worth of living expenses in your emergency fund. This means if your monthly expenses are $3,000, you should aim to save between $9,000 and $18,000. Of course, this can vary depending on your personal situation. If you have a high-risk job or irregular income, you may want to save more. How to build an emergency fund. Building an emergency fund takes time and effort, but it's worth it in the long run. Here are some steps you can take to build your fund. 1. Set a goal. 2. Determine how much you need to save and set a specific goal. Make a plan for how you will reach this goal, whether that's setting aside a portion of each paycheck or cutting back on non-essential expenses. 3. Start small. 4. If you're just getting started, it's okay to start small. Aim to save $500 or $1,000 as a starting point. Once you've reached this goal, you can gradually increase the amount you're saving. 5. Automate your savings. 6. Set up an automatic transfer from your checking account to your emergency fund each month. This ensures that you're consistently saving and helps make saving a habit. 7. Cut back on expenses. 8. Take a hard look at your expenses and find areas where you can cut back. Maybe you can cancel a subscription service or eat out less frequently. Every little bit helps. 9. Use windfalls. 10. If you receive a bonus at work, a tax refund, or other unexpected income, put it towards your emergency fund. This can help you reach your goal faster. 11. Keep the fund separate. 12. It's important to keep your emergency fund separate from your other accounts. Consider opening a high-yield savings account specifically for this purpose. Building an emergency fund can take time, but it's a crucial step in achieving long-term financial security. By setting a goal, starting small, automating your savings, cutting back on expenses, using windfalls, and keeping your fund separate, you'll be on your way to building a solid emergency fund that can help you weather any financial storm. Chapter 10. The Impact of Debt on Mental Health. While debt is often viewed as a financial problem, it can also have a significant impact on your mental health. Debt-related stress and anxiety can lead to a range of negative emotional and physical health outcomes. Here's what you need to know about the link between debt and mental health. The connection between debt and mental health. Debt-related stress can lead to a range of mental health issues, including anxiety, depression, and even suicide. The stress of owing money can be overwhelming, and can leave you feeling trapped, helpless, and hopeless. It can also lead to physical symptoms, such as headaches, muscle tension, and fatigue. Studies have shown that people with high levels of debt are more likely to experience mental health issues. In fact, a recent study found that people with high levels of debt were 3 times more likely to have a mental health disorder than those without debt. The effects of debt on mental health. 1. Anxiety and depression. Debt can lead to feelings of anxiety and depression, as well as a range of physical symptoms, such as headaches, muscle tension, and fatigue. 2. Lower self-esteem. The stress of debt can lead to lower self-esteem, which can further exacerbate mental health issues. 3. Relationship problems. Financial stress can also lead to relationship problems, as couples argue over money and struggle to manage their debt. 4. Insomnia and sleep problems. Debt-related stress can make it difficult to sleep, leading to insomnia and other sleep problems. 5. Substance abuse. People who are struggling with debt may turn to drugs or alcohol as a way to cope with their stress and anxiety. How to manage debt-related stress. If you're struggling with debt-related stress, there are steps you can take to manage your mental health. 1. Talk to someone. Talking to a trusted friend or family member, or a mental health professional, can help you manage your stress and anxiety. 2. Seek financial help. Working with a financial advisor or credit counselor can help you create a plan to manage your debt and reduce your stress. 3. Practice self-care. Practicing self-care, such as exercise, meditation, or spending time outdoors, can help reduce your stress and improve your mental health. 4. Stay positive. It's important to stay positive and focus on the progress you're making, rather than the debt you still owe. Celebrate small victories and take steps to improve your financial situation, one step at a time. In conclusion, it's important to recognize the impact of debt on mental health and take steps to manage your stress and anxiety. Seeking financial help, practicing self-care, and talking to someone can all be effective strategies for improving your mental health and managing your debt. Chapter 11. The importance of addressing behavior and habits when paying down debt. Paying down debt is not just about the numbers. While it's important to create a budget, reduce expenses, and increase income to pay off your debt, it's also crucial to address your behavior and habits around money. Your spending habits and attitudes towards money can have a significant impact on your ability to pay down debt and stay debt-free in the long run. Here's what you need to know. The role of behavior and habits in debt. Your behavior and habits play a significant role in your debt. If you have a tendency to overspend, ignore your budget, or use credit cards to cover expenses, you may be more likely to accumulate debt. Changing your behavior and habits can help you break the cycle of debt and achieve financial freedom. Steps to address behavior and habits. 1. Understand your triggers. Identify the situations or emotions that trigger your spending. Do you tend to overspend when you're stressed, bored, or trying to keep up with others? Understanding your triggers can help you avoid them or find healthier ways to cope. 2. Create a plan. Create a plan to address your debt and change your spending habits. This may involve setting financial goals, creating a budget, and finding ways to increase your income or reduce your expenses. 3. Find support. Find a friend or family member who can support you on your journey to pay down debt. You may also want to work with a financial coach or counselor who can provide guidance and accountability. 4. Celebrate small victories. Celebrate small victories along the way, such as paying off a credit card or sticking to your budget for a month. This can help you stay motivated and build momentum towards your financial goals. Changing your behavior and habits around money is a process, and it may not happen overnight. However, by addressing the root causes of your debt and developing healthy financial habits, you can lay down debt for good and achieve financial freedom. Chapter 12: Advanced Strategies and Tips to Pay Off Debt. If you've already tried basic strategies like creating a budget, reducing expenses, and increasing your income, you may need to explore more advanced strategies to pay off your debt. Here are some tips to help you tackle your debt more effectively. 1. Snowball versus avalanche method. The snowball method involves paying off your debts in order of smallest to largest balance, while the avalanche method involves paying off your debts in order of highest to lowest interest rate. While the avalanche method can save you more money on interest, the snowball method can be more motivating by allowing you to see progress faster. Choose the method that works best for you. 2. Balance transfers. Consider transferring high-interest credit card balances to a card with a lower interest rate. This can save you money on interest and allow you to pay down your debt more quickly. Just be sure to read the fine print and watch out for balance transfer fees. 3. Debt consolidation. Debt consolidation involves combining multiple debts into a single loan or line of credit. This can make it easier to manage your payments and may lower your interest rate. However, be careful to avoid falling into the trap of taking on more debt. 4. Negotiate with creditors. You may be able to negotiate with your creditors to lower your interest rate, waive fees, or create a more manageable payment plan. Be prepared to explain your situation and show that you're committed to paying off your debt. 5. Find extra sources of income. Look for ways to earn extra income, such as selling items you no longer need, freelancing, or starting a side hustle. Every extra dollar can help you pay down your debt faster. 6. Consider a debt management plan. A debt management plan involves working with a credit counseling agency to create a repayment plan that fits your budget. The agency may be able to negotiate with your creditors to lower your interest rates and waive fees. Just be sure to choose a reputable agency and read the terms carefully. 7. Stay motivated. Finally, remember to stay motivated and celebrate small victories along the way. Paying off debt can be a long and challenging journey, but the rewards of financial freedom are well worth it. By using these advanced strategies and tips, you can accelerate your debt repayment and achieve financial freedom more quickly. Just be sure to choose the methods that work best for your situation and stay committed to your goals. Chapter 13: Conclusion. Getting out of debt is not an easy task, but it's one that's worth the effort. By taking control of your finances, you can reduce stress, improve your credit score, and achieve financial freedom. In this book, we've covered a variety of strategies and tips for paying off debt, increasing your income, building an emergency fund, and reducing expenses. The journey to becoming debt-free requires discipline, commitment, and a willingness to change your habits. It's important to remember that becoming debt-free is not just a math game. Your behavior and habits play a big role in your success. By cultivating good habits, like sticking to a budget, tracking your spending, and avoiding unnecessary purchases, you can make lasting changes to your financial situation. One of the most important things you can do when paying off debt is to stay motivated. It can be easy to get discouraged or overwhelmed, but it's important to remember why you're doing this. Whether it's to save for a down payment on a house, start your own business, or achieve financial independence, keep your goals in mind and stay focused on the end result. Remember, getting out of debt is a journey, not a destination. It may take time and effort, but the rewards are worth it. By taking control of your finances, you can create a more secure and stable future for yourself and your loved ones. Best of luck on your journey to becoming debt-free.